Marcus opened his first Forex account with $2,000 he had saved for a car down payment. 3 weeks later, the account showed zero. He did not pick a terrible currency pair. He did not get unlucky on some random news event. What emptied his account was leverage on a trade that was maybe 40 pips wrong, turned into a full account wipeout because of how much size he was carrying. This happens every week to someone watching a video that promised the market would make them rich in a month. Nobody sat Marcus down and showed him the math first. That is what we are fixing right now, using his exact mistake as the map and a live Eurodollar chart to show you exactly where this goes wrong and exactly what stops it. Here is the promise Marcus saw everywhere. Turn $2,000 into $50,000 in a month. Screenshots of yachts. Claims of triple-digit weekly returns. Now here's what a genuinely skilled professional targets. Something like 2 to 5% in a good month. And some months are flat or red. Forex can produce strong returns over years. It does not produce lottery outcomes over weeks, and anyone selling that outcome is selling a myth, not a method. The real number is smaller, slower, and it compounds. But small and slow does not sell subscriptions, so the loud claim is the one that reaches new traders first. Which leads to the question that actually matters. If the promise is fake, how many people really succeed doing this for real? Quick pause. Before I show you the number, guess. Out of every 10 people who open a retail Forex account, how many are still consistently profitable a year later? Hold that guess. The Forex market moves around $6 trillion a day, more volume than every stock market on earth combined. That size, plus the fact that it never really closes, plus the fact that trends can run for hours, pulls in an enormous number of new traders every month. And yet, across broker studies, only around 1 in 10 retail accounts stays net profitable over time, not because the market is rigged, because even professional desk traders lose on close to half their individual trades. They are not paid to win every trade. They are paid to lose small and win big. Marcus never learned that difference. Here is exactly what happened to Marcus, drawn out. Leverage lets you control a large position with a small deposit, say controlling $10,000 of currency, with only a few $100s of margin. That is not evil, it is a multiplier, on the way up and on the way down. Marcus was carrying leverage high enough that a 40-pip move against him, less than half of 1%, erased his entire $2,000. And that $2,000 was money marked for a car, not spare risk capital. That second mistake matters as much as the first. Risk capital is money you could lose completely tonight and still pay rent tomorrow. If a losing trade would touch your actual life, the position is too big before you even look at the chart, and no amount of skill fixes that math after the fact. So if it is not just leverage, what actually separates the 1 in 10 from everyone else? 5 things, and almost every blown account is missing at least 2. A written plan for entries and exits, real training instead of guessing. Discipline to follow the plan when it is uncomfortable. An actual edge, meaning rules that win more than they lose over many trades. And money management, meaning sizing that survives a losing streak. Underneath all 5 sits psychology. Discipline is a skill, the same as reading a chart. Staying calm after 3 losses in a row, not moving your stop because you are hoping. That is trained, not born. And the part that actually saves an account when all of this gets tested for real is coming up next. There is one more piece of context Marcus did not have. Who is actually on the other side of his trade? Retail traders share this market with major bank desks, trading positions worth billions, hedge funds with research teams, and algorithmic systems executing thousands of orders a second on data no person can react to that fast. That is not a reason to quit. Retail traders profit here every day. It is a reason to stop thinking of trading as guessing direction and start thinking of it as risk control, because you will not outguess a machine, but you can absolutely outdiscipline one, since an algorithm does not care about your account, and only you can protect it. Let's look at the exact type of setup Marcus was trading when leverage caught him, a bearish engulfing. Classify it out loud, because this matters. It is a simple pattern, just 2 candles, it is bearish, and it is a reversal pattern, meaning it is trying to turn an uptrend down. It forms when a green candle is completely swallowed by a red candle the next session, closing below where the green one opened. Here is the full frame for trading it, always. Entry trigger. A break below the low of that red engulfing candle. Stop placement. just above the high of the red candle, with a little wiggle room, maybe 5 to 10 pips, because price often pokes back up before it reverses. Target, measured through risk to reward, so if your stop is 20 pips away, you are looking for at least 40, a 2-to-1 payoff. Now pause this video, pull up your own chart, and find one bearish engulfing candle before I show you why the shape alone was never the real signal. Here is a live Eurodollar chart, the exact market this whole video has been about. Do not just hunt for two candles that look engulfing. That shape shows up dozens of times a week, and most of them do nothing. Context matters more than the shape itself. Is this engulfing candle happening at a level price has respected before, at the top of a clear run higher, somewhere real supply might sit? That same two-candle shape sitting in the middle of nowhere on the chart is just noise. So scan left to right, find a swing high or a prior resistance zone first, and only then check whether an engulfing candle is forming right at that level. If it lines up, that is a real signal. If it is floating in open space, that is where accounts like Marcus's start leaking, one low-quality signal at a time, and remember, even a perfect pattern at a perfect level still fails sometimes, which is exactly why the stop exists. So here is where this actually goes. Forex trading is a skill, the same category as flying a plane or reading an X-ray, built through repetition, not discovered in a weekend. The bridge between knowing this framework and risking real money is a demo account. Same live prices, zero real risk, where you take the next 50 setups using this exact entry, stop, and target process and track whether your edge is real before a single real dollar is on the line. This is the thing this entire video was actually building toward. Not one pattern, not one trade, but proof, on paper first, that your process wins over time. Once that is true on demo, you scale in slowly, same rules, real money, still small. Write this down. Amateurs count pips, professionals count risk. If Marcus had followed that one line, he would still have his $2,000. Quick recap before you go. Risk capital only, never money earmarked for rent or a car. Leverage multiplies losses exactly as fast as it multiplies gains, so size, before you look at the chart. Context beats pattern shape every time. A shape at the wrong location is just noise. Every trade needs a real entry trigger, a stop with wiggle room, and a target measured through risk to reward, because the pattern will fail sometimes and the stop is the only thing protecting you when it does. And prove your edge on a demo account before a single real dollar is on the line. Marcus's $2,000 is gone, but yours does not have to be. Tell me in the comments which pair you are practicing this bearish engulfing setup on. Next time, we take this same risk framework and build your first real position size, the number Marcus skipped entirely.